Hello guys, Assalamu alaikum everyone. This is Shoaib Yaqub. Please tell me voice is clear. Perfect. Welcome to second session of this practice session. Today we will solve a second question of September-December 2020. This question is related to international investment appraisal. Yesterday question was related to the cost of capital and today's question is related to the international investment appraisal. So let's start with the requirement. Evaluate the suitability of the investment proposal in Canvia, including the impact of the country risk premium on the NPV of the project. So we have to evaluate the investment proposal in Canvia, and normally we evaluate investment appraisal projects using APV or the NPV methods. Obviously, in case of APV, normally financial risk will be different. Subsidized debt will be given, issuance cost will be given. So it is very easy to identify the APV question. If there is no sign of APV is given, that means we have to evaluate the project using the NPV method. This point is a new point, that is country risk premium. So we have to discuss the impact of country risk premium on the NPV. We will discuss this after reading the scenario. Next is explain possible strategies Colvin company could adopt to avoid a block on the dividend remittance if Canvia opposition party was to win the election. So let's suppose if opposition party put stop on the remittance, put blockage on the remittance, then how Colvin company will manage that situation. So we have to discuss that part for 4 marks. In third part, discuss the validity of the CEO reason for adjusting the discount rate used in appraising the project in Canvia. So we have to read the scenario first, that what is the reason of CEO, then we have to discuss the validity of that comment. Okay, 15 marks, almost 15 marks are for the numerical and 10 to 12 marks for the theory. Colvin company is based in the Eurozone region and was established 10 years ago to manufacture competition standard bicycle for professional road racers. When the company obtained a listing 5 years ago, the founder retained a small minority shareholding. The remaining shares are held by a number of institutional investors. So the main owner of this company are institutional investors. The board recently decided to expand the range of models, the range of bicycle models, and to look for a new growth opportunities abroad. Whilst manufacturing is currently restricted to the Eurozone, the board of directors has identified Canvia as a key growth market and is considering a potential investment project to manufacture and sell a new model there. So Canvia is a country in which you are going to invest. This would involve establishing a subsidiary in Canvia. The currency in Canvia is the Canvian lira. Lira is the currency of Turkey. So in this part, the currency in Canvia is the Canvian lira and the current exchange rate is 9.91 lira per euro. The annual rate of inflation in Canvia is expected to remain at 10% throughout the 4-year duration of the project. So the project duration is 4 years and the inflation of the Canvia is 10%. The finance director estimates the project sales volume, inflation adjusted pre-tax contribution and fixed costs are as follows. So this sale volume is given, pre-tax contribution, inflation adjusted contribution is given. So there is no need to change this. Then fixed cost is given. Fixed cost is also inflation adjusted. The project will require an immediate investment of 75 million lira in land and building and 700 million in plant and machinery. Tax allowable depreciation is available on the plant and machinery on a straight line basis at an annual rate of 25%. Colvin Company Finance Director believes that plant and machinery will have a zero residual value at the end of 4 years. Land and building will be disposed of at the end of the project, and their tax exempt value is expected to be increased at annual rate of 30% throughout the 4-year life of the investment. So no initial investment for the plant and machinery is given, but there is a value for the land and building is given. So what will be the possible value, disposal value of land and building at the end of 4th year? Can you calculate? Initial value is 75 million. Read this line clearly. Land and building will be disposed of at the end of the project, okay, and that their tax exempt value, so that means we do not have to apply tax on it, is expected to increase at an annual rate of 30%, throughout the 4-year period. So that means we will increase it with a rate of 30% by putting the power of 4, because the land and building will increase by 30% annually, and for 4 years we will have to inflate it, or we have to put the power of 4. So what is the value after 4 years? 214.2 approximately. The project will also require an immediate investment in the working capital of 25 million lira. Annual working capital requirement is expected to increase in line with the inflation in Canvia. And what was the inflation in Canvia was given? 10%. And will be released back in full at the end of the project. Colvin Company has a policy of extracting remittable cash flow as dividend at the earliest possible opportunity. So every year you will remit 100% of the cash flows to the parent company. All component for the new bicycle will be produced or purchased in Canvia except for a gearing system component. It is not the financial gearing, it is the gearing of the bicycle, which will be manufactured by Colvin Company in the Eurozone. So you will import gearing from the parent company. The cost of acquiring this component from the Eurozone is already included in the pre-tax contribution. So that means you have included the cost in your pre-tax contribution calculation. So we do not have to add cost here. We do not have to deduct the cost there. Based on the transfer price of 10 euro per component. Shoaib is the gearing of the bicycle. You know, recently the racer bicycles have some gears. By shifting the gears, you can increase the speed. By shifting the gears, you can reduce the speed. These are the gears of the bicycle. It's not the typical financial or operating gearing. It's the gearing of the bicycle. So your subsidiary is in Canvia, and you will import the gear system from the Eurozone, and the cost of that system is 10 euro. And you have already included that cost in this calculation. It is written here. The finance director estimate a manufacturing cost of 2 euro per component. Actually, the actual cost of that gearbox is 2 euro. But the parent company has transferred that gear system to the subsidiary at 10 euro. So by the way, how much parent company is earning? 8 euro. Remember, what is this? This is the contribution earned by the parent company. So parent company is earning 8 euro contribution. Both the transfer price and the manufacturing costs are expected to increase in line with the Eurozone annual inflation rate of 4% in the first 2 years and 2% in the year 3 and 4. So you will increase this contribution. This is a contribution earned by the parent company. There will be no impact on the subsidiary. This is the contribution earned by the parent company. And this contribution will increase every year with the 4% for first 2 years. Then it will increase by 2% for the next 2 years. Corporate tax in Canvia is 25%, and companies are allowed to carry losses forward to be offset against the future trading profit. So that means you will carry forward the losses. Colvin company pays corporate tax in its home country at annual rate of 20%. So do we have to pay additional tax? No additional tax. No additional tax. Taxes are payable in both countries in the year the tax liability is incurred. A bilateral tax treaty exists between the two countries, which permits the offset of overseas tax against any domestic tax liability incurred on the overseas earnings. Discount rate. The board proposes financing the project with a mix of equity and debt in such a way that the existing capital structure remains unchanged. So that means we will not apply APV here because capital structure is same. For the purpose of this project, business risk and financial risk both are same. Business risk and financial risk both are same. How I have identified that business risk is same? Because you are opening a subsidiary in other country doing the same business. So business risk and financial risk both are same. For the purpose of this project, CEO believes Colvin company weighted average cost of capital of 13% should be adjusted to include a country risk premium on the basis that Canvia is a developing economy and appears to be economically less stable than the Eurozone countries. He made this decision after consulting a country risk index which compares the standard deviation of the market returns in various countries. Okay, what is country risk premium? Actually, if your parent company is in Eurozone and you want to invest in developing countries, and obviously when you want to invest in a developing country, there will be a risk of political instability, there will be a risk of exchange rate instability, there will be a risk of fiscal or monetary instability. So that's why director is saying that if you want to invest in a emerging country, we will have to increase the discount rate to reflect that risk. Is it making sense? After reading this statement, let's suppose you are in Eurozone or America or UK. You are in developing country and you want to invest in Pakistan, Bangladesh, or any nearby country where political system is not that strong, where exchange rate risk can become dangerous, where fiscal or monetary problems can arise. So in order to reflect that risk, you want to increase the discount rate. And that additional risk is country risk premium. That additional risk will be compensated from the country risk premium. So we have to increase the cost of capital. Is this statement making sense? Is it true that if we want to invest in a less developing country, we should increase the discount rate to reflect the additional risk? I'm not asking the solution. I'm just asking, is this statement making sense? I'm again repeating the statement, guys. Listen. Parent company is in USA. Let's suppose. And you want to invest in emerging country. or less developed country, any Asian or African country. Normally, emerging countries are mainly in Asia and Africa. So, USA company wants to invest in an emerging country. There are some problems with the emerging country. Political system, weak political system, exchange rate instability, fiscal problems. So, obviously, if you want to open a subsidiary in emerging country, you will be facing these additional risks. So, in order to address these risks, you want additional premium. So, you will in normal WACC is 13%, but you will increase the WACC, like you will increase the WACC to let's suppose 16% to reflect this risk. Because of this additional risk, you will demand additional premium. That is called country risk premium. So director is saying that you want to invest in a less developed country and there can be more risk in that country. So to compensate for that risk, you should increase the discount rate. So country risk premium is the compensation for the additional risk which you are taking by investing in a less developing country. Now, please tell me, is it making sense? Is director is right? Okay. To the shareholders, to the share compensation paid to the shareholders, obviously, some these are the owners of this company to the shareholders. Okay. Now I'm making another statement. Now listen in using another angle. If this USA company, if this company investing in an emerging country, obviously there will be a risk. But if this company is a multinational company, if this company, please listen carefully, if this company is a multinational company, this company must have invested in a more developed country. Obviously, if this company is a multinational company, this company must have invested in a more developed country. So that means this company will be facing lower risk. So that means we can argue that if this company is investing in an emerging country, obviously there will be some additional risk. But this company must have invested in a more developed country where there will be lower risk. So that means their risk will be diversified already. So there is no need to add country risk premium. So another point is, if this company is a multinational company, if this company is a, what was the name of the company? Colvin. If this company is a multinational company in Eurozone, this company invested in a, what is the name of this country? Convia. This company has invested in Convia, emerging country. So risky company. This is a risky investment. This company must have invested in other country like USA, like UK, where there will be less risk. So that means this additional risk will be diversified away by the company if this company has invested in different countries. So there is no need to add country risk premium while evaluating the investment. Because if this company is investing in Convia, which is a risky country. This company has already invested, maybe this company may have already invested in less risky countries. So this risk has already been diversified away. So there is no need to add additional risk premium in the WAC. Okay, now look, let's discuss in another way. Majority shareholders are institutional investors. Majority shareholders are institutional investors. And institutional investors have already diversified their risk away. Diversified away their risk. So if the Colvin company owners are institutional shareholders have already invested in many companies across many countries. So they will not bother about the country risk premium because they have already diversified their risk away by investing in many companies across the globe, because institutional investors normally invest in many companies relating to the many countries. So you have to discuss this statement. I was discussing this statement in detail because of the last part. Look, let's read the requirement again. Discuss the validity of CEO reasons for adjusting the discounted used in appraising the project in Canvia. So CEO is saying that you should increase the discount rate to reflect the additional risk. So you have to write the pros and the cons of that statement. Understood? You have to write some points in favor of the statement and some points against for the statement. So if you write the positive or the negative points for the statement, that will complete the definition of the word discuss. Okay, last paragraph. Additional factors taken into consideration include foreign exchange risk, the fact that there have been frequent changes of government in Canvia, and the main opposition party has threatened to reintroduce the control on dividend remittance if elected. So the main opposition party is saying that if they get into power, they will put restriction on the remittance. Yes, you have therefore been asked to use a discount rate of 16% to appraise this investment. So actual discount rate is 13%, but you have been asked to appraise the project using 16% to reflect the additional risk. So which discount rate should we use? 13 or 16? We will use the 16% discount rate and calculate the NPV, but we will also use the 13% discount rate to calculate the NPV, and then we will explain that at which rate NPV is positive or negative. We will discount at both rates. And what is the reason of discounting at both rates? Because in requirement, examiner has asked, evaluate the suitability of the investment proposal in Canvia, including the impact of country risk premium. So we will discount at 13%, NPV will be higher. Then we will discount at 16%, NPV will be lower. And we will explain that the country risk premium impact is negative on the NPV. I have already told the reason that examiner has asked to calculate the impact of the country risk premium. Without country risk premium, discount rate is 13%. Let's suppose NPV is 1,000 million positive. And if we discount at 16%, NPV is, let's suppose 600 million. So what is the impact of country risk premium? 400 million. Okay, we have to explain the impact. Okay, let's calculate. No, we are not assuming, we were just discussing. We were just discussing, and that was The discussion of the part C, not the part A. Okay, guys, let's solve the question. Okay, tell me. We will make pro forma in euro or the lira? Please tell me. Lira. Whenever there is a question on the international investment appraisal, you will make the full pro forma into the subsidiary currency, calculate net cash flows, then convert the net cash flows into euro, into the parent currency. First subsidiary, then parent. Make the years 0, 1, 2, 3, 4. In normal question, starting point is sales, but here the starting point is the pre-tax contribution, because examiner was kind to give us the complete figure of contribution. So please copy the contribution here. 419.4, 500.2, 671.3, 961.2. Guys, you can also solve on the Excel. If somebody is preparing for the computer-based exam, please solve on the Excel. You can quickly solve on the Excel. Then deduct the fixed cost. And fixed cost is also inflation adjusted: 270, 291.6, 314.9, 340.1. Now deduct the tax depreciation. And that is 25% of the 700 million. 25% of the 700 million. 175 each year. Please calculate the taxable profit. In first year, it will be 25.6 negative. Second year, 3.6, 33.6. Third year, fourth, and obviously we can carry forward the losses. Apply the tax here. We can carry forward the losses. So we can solve this part in the working. Carry forward losses 25.6. Profit will be 8. Tax rate is 25%. It will be 2. $45.35 in excess, 111.53. Let's copy this text to the above performer. No text 2, 45.35, 1.53. Add back the text depreciation. 175, 175, 175, 175. Now calculate the working capital change. Working capital, first of all, calculate the working capital requirement. In year 0, working capital was 25. And every year it will increase by 10%. Every year it will increase by 10%. So next year it will be 27.5, right? $30.25. 33.28. Working capital change will be 25, 2.5, next will be 2.75. $3.03, 33.28. Please check the calculation. $25, 2.5, 2.75, 3.03, 33.28. Investment includes 2 assets. If it's a first year in business, will loss carry forward will be the same. This was the first year in the business. This was the first year. And it was stated in the question that if there is loss, you can carry forward the losses. What is the sum of investment? There was 2 investment, right? 700 plus 75. This will be 775. And residual value? Residual value will only be for the land and building. And land and building will increase every year by 30%. We have already discussed that point. It is 214.2, right? Please calculate the net cash flows. All of these net cash flows are in lira. $175 minus 2.5 minus 25.6, 146.9. 33.6 plus 175 minus 2 minus 2.75, 203.85. 308.02. And last one, 757.06. Okay, all of these cash flows are in lira. Now what we will do, we will write the exchange rate here and convert these cash flows into euro. So we have to calculate the exchange rate. What is the current exchange rate? $9.91 lira over euro. Exchange rate. $9.91. It's lira over euro. And lira inflation is 10%. And the euro inflation is, what is the euro inflation? 4%. So next year it will be 9.91 into 1.1 raised divided by 1.04. It will be 10.48, right? Next year it will be 10.48 into 1.1 divided by 1.04. 11.09. Next year 11.09 into 1.1 divided by 1.02. 1.02. 11.96. 12.89. Now write all the exchange rate above. $9.91. These are lira over euro. 10.48, 11.09, 11.96, 12.89. So what we have to do, we have to convert the lira into euro by dividing or multiplication. By using the division or multiplication? Division. Please convert. $80.73. $14.02. Sorry, it's positive, right? $18.38. $25.75. The last one is $58.73. Okay. Is there any parent company specific cash flow? Additional tax? No. Contribution loss? No. Is there any additional cash flow for the parent company? Contribution income, right? Contribution income. Let's solve in the working. So what is the contribution per unit? you are earning 8. And this 8 will increase every year with inflation. So in year 1, it will be, and guys, directly take its after tax value. 1 plus inflation. Let's directly calculate. Okay, leave the text. We will calculate text in second step. It is 8.32, right? Then 8.32 into 1.04. It will be 8.65. Yes, this is contribution per unit. And next year it will increase by 2%. 8.8, 8.83. 9. Then you will multiply it with units. And you have to copy the units from the question. Units are 109, 725, 121, 795, 148, 590, 197, 624. Multiply with the units. 109, 725, 121, 795. In third year, 148, 590. Please cross check the figures of the unit. Okay, now calculate the contribution. Directly calculate the after tax contribution by multiplying the units into contribution per unit and into after tax value. And convert these into millions. 8.32 into 109, 725 into 0.8 divided by 1 million. This is 0.73. Point 84. $1.05. Please cross check all the figures. I have deducted the tax. 1.42. Point 73, 0.84. 1.05, 1.42. Is there any other cash flow? No. So let's calculate the net cash. So firstly, we will discount these cash flow at 16%, then at 13%. Don't we have to discount Canvia first? No. That was the special case of international APV. In NPV, you will have to convert all the cash flows into the parent company, and then you will simply discount that. I think you're confusing with international APV. Guys, please calculate the discounted cash flow both at 16% and 13% and calculate the NPV. Please tell me the discounted figures. Negative answer, right? And what about at 13%? Obviously, answer will be better in case of 13%. If you can't do calculation faster than me, I think then there should be a point of concern. Please cross-check the calculation. Okay, that means our decision is totally based on the discount rate which we are using. If we use the discount rate 13%, answer is positive and we should accept the project. If we are using the 16% discount rate, our answer is negative and we should not do the project. So we have to further explore the discount rate, or we have to do the further research on the discount rate, that which discount rate is useful in this calculation. Obviously, if you are using Excel, you can quickly solve these calculations. You just have to apply the NPV formula. I think that is NPV bracket start. You will select all these cash flows, then apply the discount rate. Exactly. You can simply solve that. So guys, let's move to the answer and let's read that what examiner has done there. So we have done that part, the numerical part. At 16% answer is 3.3 negative, and at 13% answer is positive. Okay. Please read the comments of examiner. The decision whether to accept or reject the project critically depends upon the discount rate. Umar is asking, do we have to write the formula or directly put values in the formula? Umar, which formula are you talking about? Any formula? Are you asking generally? You do not have to write any formula in AFM exam. Just put the values directly in the formula, except one case, ratio analysis. In case of ratio, if you let's suppose if you are calculating the ratio, any ratio, you have to write the formula there. Except ratios, never write the formula. Directly put the values into the formula. Okay, let's read the answer. Decision whether to accept or reject the project critically depends upon the discount rate. Switching from a negative NPV of 3.3 when the discount rate includes a continuous premium to a positive NPV when there is no premium. This adjustment to the weighted average cost of capital requires further investigation because it is possible Colvin company could reject project that increases shareholder value. Bas, that's it. Examiner has written that at 13% answer is positive, at 16% answer is negative. You have to do further research, further investigation that which discount rate should be used. If 16% is relevant, we shouldn't do the project. If 13% is relevant, we should do the project. So guys, remember this. Whenever there is slight NPV, slightly positive NPV or slightly negative NPV, never write the rejection or the acceptance straightforward. Let's suppose if answer is slightly positive or answer is slightly negative, always write in case of positive that although we should accept the project as NPV is positive, but we should do further investigation using sensitivity analysis or scenario analysis, and we should evaluate the our assumption, the validity of our assumptions. Even in case of negative, you will write that although answer is negative and we are not going to invest the project, but we should do the further research by using the scenario analysis and the sensitivity analysis, and we should also do the investigation or the research about the validity of our assumption. Always write these statements in case of slightly positive or slightly negative NPV. And when NPV is positive and the figure is very high, if there is a deep in the money scenario, like NPV is very positive or the NPV is very negative, then you can simply write that accept the project or reject the project. Okay. So the last two lines, outcome assumes that contribution and other cash flows are reliably estimated. Other critical inputs include the assumptions that land and building will increase in value at annual rate of 30% and that any disposal is tax exempt. These are also assumptions. You have written the simple assumptions here. Nothing critical here, nothing special case. Okay, what about the B part? explain possible strategies. Shaz is asking, in the CB exam, is it enough to do the calculation in a cell? And examiner will see our logic, or do you also have to show the calculating formula in addition to the putting the values in a cell? Yes, you are right. Examiner will see the working from the cell. Don't worry. Zayad is asking, do we have to compare the NPV with initial cost to estimate the NPV is slightly positive or negative? Do we have to compare the NPV with the initial cost? No, if NPV is slightly positive or negative, that means you have already deducted the initial cost. You have already done that part. You have already compared with the initial cost. Okay. Okay, in B part, explain possible strategies. Explain possible strategies Colvin company could adopt to avoid a block on dividend remittance if Canvia opposition party was to win the election. Explain possible strategies Colvin company could adopt to avoid a block on the dividend remittance. Let's suppose opposition party gets into the power and they put blockage on the remittance. Then what you would do? Guys, any suggestion? Let's suppose government put the blockage on the remittance. How? What you will do? There are number of solutions available. Number one is, let's suppose if your company belongs to a developed country and you have opened a subsidiary in a poor country, you can create a lobbying and put pressure on the government. To remove this. Number one point. Number two, increase the transfer price. Previously, transfer price is 10 euro. Increase the transfer price to fetch maximum amount from the subsidiary country. Number three, apply royalty or management fee. Apply royalty or management fee to the subsidiary and try to fetch amount from the subsidiary. Number four, provide using intercompany loan. Using intercompany loan, you can transfer funds from subsidiary company. Your subsidiary company will provide loan to another company and you will receive that amount from that company. Sokal, number one point is, let's suppose the parent company is Nestle. Let's suppose parent company is Nestle and you have opened a subsidiary in emerging country. And if emerging country has put restriction on the remittance, you will threat the government, you will create a lobbying with the other multinational. Let's suppose if Nestle, Unilever, Coke, Pepsi, all these get together, they can put pressure on the government. What kind of pressure? That they will withdraw all the funds from your country if you put the restrictions. So by putting pressure on the government, you can remove this restriction. Understood? Okay, next is number 4, intercompany loan. Let's suppose parent company is in UK. Your one subsidiary is in Pakistan, other subsidiary is in India, and Pakistani government has put the restriction on the dividend restriction. So what you will do, you will ask the Pakistani subsidiary to give loan to the Indian subsidiary, and you can receive funds from here. Okay, get this point? Okay, point number three is you will ask the subsidiary to give you royalty or management fee. You will ask the yes, this can also happen. You will ask the subsidiary to give you royalty because you have given some license to the subsidiary. So instead of paying you profits, subsidiary will start paying royalty to you. Royalty will become expense to the subsidiary books and it will become income to the parent company. Same is the case of management fee. You will ask the subsidiary that you are giving some skills to the subsidiary and subsidiary will paying you the management fee. Okay. So let's read the answer here. It's not 1 mark per suggestion. You will get 4 marks if you able to explain even 2 to 3 suggestion thoroughly. Okay, this is the answer of this part. Let's read it. There are a number of possible strategies to avoid exchange control on remittance. Colvin Company could increase the transfer price paid by the Canvian subsidiary for the gearing system. Obviously, we have discussed that. This would increase Colvin Company profit to detriment of the subsidiary profit. Alternatively, Colvin Company does not currently levy a management charge or royalty, but if these were introduced, it would transfer profit from the subsidiary. These methods assume that exchange control imposed in Canvi are not applied to the repatriation in general. We are assuming that exchange controls are only on the dividends, not on the repatriation. Repatriation means any outflow from the country. So we are assuming by giving the suggestion that government has imposed the restriction on the dividends only. This is repatriation. Repatriation means if you give funds to the other country, like let's suppose we are sitting in Pakistan and we have opened a subsidiary in UK, and that subsidiary is annually paying us cash flows in shape of profit, in shape of royalty, in shape of management fee, in shape of anything. And that annual inflows are the repatriation from the UK to Pakistan. Okay. Next is an alternative word. An alternative would be for Colvin Company subsidiary to make a loan to the Canvian subsidiary of another Eurozone based parent company, which in return would lend an equal amount in euros to the Colvin Company. The same objective would be achieved with a currency swap, although counterparty risk would be a factor in both cases. So you can also take funds from the subsidiary by arranging a loan there. So what subsidiary will do? Subsidiary will give a loan to another subsidiary and you will arrange funds from that company. Okay, that was the part of B. So let's read the third part. Discuss the validity of the CEO reason for adjusting the discount rate used in appraising the project. I have discussed the statement when I was reading the scenario. So I have already discussed the pros and cons. What was the pro? Pro was you are investing in a emerging country. There will be additional risk of political or the exchange rate system there. So in order to counter that risk, we should require a country risk premium. So that's why instead of discounting at 13%, we should discount at 16%. to reflect the additional risk. And what are the cons? If you are investing in a emerging country, maybe you have already invested in developed country. So your risk of investing in emerging country will be cancelled out by investing in a developed country. And majority of the owners are institutional shareholders, and those institutional shareholders are already well diversified. So there is no need to add country risk premium because those institutions have already invested in many countries. So their country risk has already been removed or reduced or diversified away. So let's read the part C. Colvin Company invested in Canvia does not involve a change in business risk or capital structure. The company weighted average cost of capital would normally be expected to provide a reasonable measure of risk for the new project. CEO justification for a risk premium is based on the increased risk the company is exposed to the Canvia, a developing economy, compared to the company existing business in the Eurozone. This perception of increased risk is based on a country risk index which compared the standard deviation of the market indexes around the world. CEO has incorporated other factors such as political risk and foreign exchange risk in determining this premium. However, standard deviation is not the appropriate measure of risk for Colvin Company investment, since any portion of the total risk that is uncorrelated across different markets can be diversified away at no cost to investors. So, what is the meaning of this statement? Let's read these statements first. For example, adverse political events in Canvia may be partially offset by more favorable events in other parts of the world. No rational investor would pay a premium for the risk that can be avoided. So, examiner is stating that this risk can be diversified away. How? The parent company is investing in Canvia and facing a risk. That parent company has already invested in other countries, which are better in terms of political and exchange rate system. So this risk will be diversified away. So if risk is a diversifiable risk, no premium should be given for that risk. Remember, in CAPM, premium is only for the systematic risk which cannot be diversified away. If the country risk is a diversifiable risk, we should not pay premium for that. Okay. Further, Colvin Company institutional shareholders are likely to be well diversified. Further, Colvin Company main owners are institutional shareholders, and institutional shareholders have already diversified their risk away. So that's why there should be no risk premium for the additional risk. Okay. Okay, the last part is the only component of the total risk that could justify a premium to Colvin Company cost of capital is market risk or undiversifiable risk. This assumes a return across countries are significantly positive correlated. For example, there is a strong possibility that a recession in the Eurozone may lead to a downturn in the Canvia too rather than offset it. So what is the explanation of this paragraph? That is, if you have invested in, let's suppose in Pakistan, and if you have invested in UK, we can say that this is an emerging country and you are facing additional risk. And let's suppose this is a developed country and there is no risk here. So here you are facing additional risk, here you are facing no risk. So we can say that this risk can be diversified away. But look into these risks by another angle, and that is, let's suppose if we discuss about the COVID. In case of COVID, in case of recession, every country is facing that. So if you are in Pakistan, India, Bangladesh, UK, Euro, every country was facing that risk. So in that case, The risk cannot be diversified away by investing in different countries. So guys, this last part answer is more general answer. I will say that read the CEO statement. CEO is saying that if you are investing in a poor country or emerging country, we will face additional risk. So that's why we should add country risk premium in the discount rate. That was the statement of the CEO. So in order to address that statement, you will write the positive and the negative point. What is the positive point is that CEO is right that if you are investing in a poor country or emerging country, you will have to face the additional risk. So that's why you will demand additional premium. And you will write something against for this statement, and that is there is no need to add the premium, because if you are investing in poor country, you must have invested in other developed countries. So your risk will be cancelled out with each other. And majority of the owners are institutional investors. So that's why they have already diversified their risk away. So there is no need to pay the premium for the additional risk. And although if you're investing in internationally, there is a risk that is, we can say that global risk. And what is that? By investing internationally, maybe we face global risk, and global risk is that kind of risk which is present in every country if you invest in developed or underdeveloped country. Like recently, what was the global risk? We can say that COVID. And surprisingly, COVID was more available in the developed country compared to the developing one. So it's a request that please read the answers just to develop the examiner expression and the vocabulary. Any specific question, guys? Let me explain the last paragraph. What is last paragraph? Look, actually examiner has written some difficult vocabulary word there. Look, how you will diversify the risk. Let's suppose if you invest in Pakistan, let's suppose you are facing additional risk. And let's suppose you are investing in USA, you are facing less risk. Both of these countries are almost at 180-degree angle. This is risky country. Let's suppose this is less risky country. And if you invest in both of these countries, your risk will be diversified a bit. Are you getting this point, Sogal? Part B. Okay, repatriation. Okay. Part B. So you are asking about the part B. Answer of part B. Okay, repatriation means, let's suppose you are in UK and you have invested in India. You have opened a subsidiary in India. And from India, you are receiving dividends. You are receiving royalty. you are receiving management fee. All of the cash flows which you are receiving from the from the other country, those cash flows are called repatriation. Okay. We are assuming that India has imposed a restriction only on the dividend, not on the royalty, not on the fee. So if Indian government has put restriction on the dividend, we will not get the dividends. There is no problem. We will start receiving funds in shape of royalty and in shape of fee. That was the point examiner was discussing in part B. Okay. Any further issue? Sogal? Okay, sub loan. What India will do? India will provide loan to other subsidiary. Let's suppose the Pakistani company. And Pak company will give that amount to the UK company because there is no restriction on there's no restriction in Pakistan. So funds move from one country to other and from other country to parent company. Simple. Here it is making loan to. An alternative would be for Colvin company subsidiary to make a loan to the Colvin subsidiary of another Eurozone based parent company, which in return would lend an equivalent amount in euros to Colvin company. To make a loan to the Canadian subsidiary of another Eurozone. This will be like this. Eurozone means, look, Colvin company is in euros, is in Eurozone, right? Colvin company is in Eurozone. An alternative would be for Colvin company subsidiary, which is in Canvia, to make a loan to the Canvian subsidiary of another Eurozone. Okay. Let's explain this another way. This is UK company. This is Indian company. Indian company wants to transfer money to the UK company, but Indian government has banned that. Now, what is written here? Actually, what is written here? That Colvin company subsidiary to make a loan to the Canadian subsidiary of another Eurozone. Provide loan to other subsidiary. Let's suppose this is parent company, this is subsidiary. This is parent 1, this is subsidiary 1. Please listen carefully. Subsidiary 1 transfer loan to another subsidiary, another company. Let's suppose this is Nestle parent, this is Nestle subsidiary. Nestle subsidiary will provide loan to the Unilever subsidiary. There is no connection between Nestle and Unilever. Nestle will provide loan to the Unilever subsidiary. And in return, Unilever parent will give that amount to the UK company, to the Nestle parent. Nestle parent has invested in India. Nestle into Nestle subsidiary company. Nestle subsidiary wants to give funds to the UK company, but you can't because Indian government has put the restriction on that. So what Nestle subsidiary will do, Nestle subsidiary will provide loan to the Unilever subsidiary. And in return of this, Unilever parent company will pay to the UK Nestle parent company. Are you getting this? Look how cleverly these companies have managed to escape funds from the India. Guys, it was technical, but I think now it is clear. Shaz is asking, we do not ignore market risk premium of a new project with the assumption of already present diversification. No. Market risk premium is the stock market risk. It has no relevance with the project. Shaz, let's suppose if you are investing in if you are investing in Canada in project A, B, or C, you have to face the you will always get the market risk premium in CAPM. And if you are investing in a risky project, beta will be higher. If you are investing in less risky project, beta will be lower, but market risk premium will be there. Yes, you are right. We are not ignoring the beta adjustment. Actually, we are not doing adjustment in the beta because financial risk is same, business risk was same, so that's why beta was same. Examiner was only discussing about the country risk premium. So we have discussed the positive or the negative points of adding country risk premium. There are few points which are justifying the addition of country risk premium, and there are few points which are against the addition of country risk premium. So whenever there is a word discuss, you have to write the pros and cons of that statement. Okay. Okay, guys. Tomorrow we have agendas to solve West Parlay question. This question is a March 2020 attempt. Okay, we will solve the West Parlay question and then we will discuss its theoretical parts. And by discussing those theoretical and numerical parts, by doing the discussion, you will always have a chance to learn the new things. So please join the live class. Although these videos will be available, but after this weekend. Okay. Thank you so much. If you have any question, you can ask me uh, in in the WhatsApp group. Thank you so much. Bye bye. Allah Hafiz. Zad, these questions, Zad, practice can never be enough, man. In last class, I will highlight those questions which will be enough for the last week practice. Okay. Allah Hafiz. No problem, no issue. आखिरी क्लास में ना वो मैं हाईलाइट करवा दूंगा क्वेश्चंस के नेम. So I will highlight like 10 to 15 questions, 10 to 15 important questions. Try to solve those. Inshallah, inshallah, you will pass the exam. Thank you so much.